Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Haag Sherman, CEO of Tectonic Advisors, to discuss Fed policy and the key changes in sentiment. Haag, it's great to have you with us. Welcome to Trade Talks.
Thank you, Jill.
Yeah, and certainly good timing for this conversation. Walk us through the key changes in the Fed statement. And do you think it was overly dovish?
Well, if you look at the market's clearly reacted in that view. But if you look at how Fed policy's changed, the Fed has always targeted inflation 2%. And so the most significant change is that they're going to run hot or higher inflation for a longer period of time before they start to begin to raise short-term interest rates. So we're range bound at 0%, really to 2023. And that's really to have further monetary easing through the increase of inflation rather than lowering rates below zero.
Do you think the Fed can be effective with that strategy?
Well, I think it's really, as it relates to rates, given that they've taken negative rates off the table. So in effect, they've taken negative nominal rates off the table. Therefore, the only way that they can further adjust interest rates through real interest rates, which are nominal interest rates minus inflation. So in effect, by setting nominal interest rates at zero and saying that they'll run above their inflation target for a period of time, what they're telling the market is they're going to lower real interest rates below 2% to hopefully further inflate and prop up the economy.
So what does this all mean, right? So if inflation continues to move higher, wouldn't that in theory impact the consumer?
Absolutely. So in effect, just like the Japanese central bank, the U.S. central bank has consistently tried over the last decade, in the case of Japan, for the last 3 decades, to stoke inflation, which is perverse given that that's one of the key tenets of monetary policy, which is not to stoke too much inflation. But we've had a lack of inflation, in some cases disinflation. So if you look at, for the consumer obviously increased inflation means lower purchasing power. But in effect, what the Fed is saying is we don't have enough aggregate demand, i.e. consumers aren't consuming enough, spending enough. We have too much capacity, therefore our businesses have little pricing power. So the only way that you can really increase that or improve that is through stoking inflation. So the Japanese central banks failed at it, or largely failed at it. It's going to be tough given the debt load that we have for our Federal Reserve to get above 2%. And so I think there's probably little risk to the consumer over the next 2 to 3 years. But over time, if they do go above that target, I think it will impact the consumer. I think that's a very good point.
You know, there's so many dots to connect here, and perhaps there's lower demand because we have, millions of Americans out of work, and the job security might not be there. So we talk about the economy, we talk about the market being disconnected. So let's think about this scenario. In 2020, COVID-19 was about business continuity and job preservation. So what happens when we get to 2021, when companies are cutting costs and jobs to operate in the new environment and focus on profitability? How do you resign job losses associated with these corporate moves? And how does that translate, again, to the consumer spend trends, even though it's going to work well for stocks, right? Stocks will react well, but the consumer and economy is going to take a hit.
And compound, I think that's an excellent point. Compound that with the lack of a fiscal response given the gridlock in Congress. So if you look at what the Fed's doing now, the Fed is stepping in trying to take over a lot of the load that really should be on the backs of Congress, because you have two levers from a governmental standpoint. You have fiscal policy and monetary policy. The dysfunction in our government is a lack of fiscal response to this pandemic after the first large bill. So getting back to your point about the consumer, unless there is a concerted fiscal response in the short term, call it the next handful of weeks or months, you're going to enter into 2021 with the economy potentially flagging, because in effect, there probably won't be a vaccine. You're going to have more job cuts as companies go into 2021 with the view of this may be a tougher year. So we need to really focus on our costs because our revenues are going to be waning, or it's going to be more challenging. So the only thing you can do is cut costs. And a significant part of any company's cost is headcount. So they're going to cut headcount, which again, to your point, weighs on consumer spending, which again makes the Fed's policy of stoking inflation increasingly difficult. So all these dots do connect. Your point's exactly right. And the lack of a fiscal response, I think, will weigh on the economy.
So, Haag, how are you positioning portfolios, certainly through the election and the end of the year with a number of these outliers on the horizon?
Well, I think if you look at areas where you're going to see, at the end of the day, businesses have to have pricing power. And so a healthy business, that's really why the FANG stocks with Microsoft have done so well, is they have dominant positions, they have big moats, high growth rates. And so if money's very, very cheap, high growth rates, you have a huge inflation in value. You've seen that. At some point, you're going to rotate back into companies that hopefully will have more pricing power. I think Goldman Sachs is a global brand. Right now, you can buy Goldman Sachs at less than tangible book. So you're buying the old Warren Buffett philosophy is if you can buy $1 for something less, you do it. You can buy a share of Goldman stock for less than its book value. You get the global franchise for free. You're buying at a good valuation, good dividend yield. That's a place to look hard. ExxonMobil, at some point, you're going to see a dramatic impact to energy and energy companies. And I think the commodity will equalize. You'll start seeing pricing power as capacity is taken out of that marketplace. In my view, if you can buy Exxon in the mid 30s with a 9.5% dividend yield, factoring in a 50% cut in its dividend, that's a good place to park money. So those are the areas that we're looking at. I don't think you'd load up on those, but I think they're good, solid buys over the next 2 to 3 to 4 years.
Hey, great to have you with us. Thanks for joining me on Trade Talks.
Thank you, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.